All right, we'll admit people in a minute.
Great. Why don't we go ahead and start now so it's not so chunked, if that's okay. Is that all right? Is everybody okay? We're just going to start admitting people.
Okay.
Hello, everyone. Welcome. Welcome.
Hello.
Nice to see everyone. Great if we can have you on screen to make it more interactive for the Q&A part of the session. Thanks for being here. I'm going to ask that our participants stay on mute just so that we can make sure there's not the background noise for anybody else who's trying to listen in here. We've got a great turnout today, so take a minute here just to let everybody in the room. I'm Lisa Spivey, I'm the Executive Director of the chapter, and my great team here with Danielle, who runs our operations, and Kate, who runs our partnerships. I think you've all had a chance to interact with them. Just admitting some more people. We'll be with you in just a minute. Well, in the interest of time, I think we'll get started. And I'm going to pass it over to our host, Joe from Heffernan, and he'll kick it off for us. Joe, over to you.
Awesome. Thank you, Lisa. Welcome, everyone. Thank you for spending an hour in the middle of your work week to talk about director liability and securities litigation trends. We have an amazing program today with some pretty high-profile guests. First, wanted to start off with a huge thank you to the NACD of Northern California. Very, very helpful and supportive group as it relates to corporate governance matters, and has been a really, really great partner for Heffernan Insurance. My name is Joe Talmadge. I lead the technology practice at Heffernan Insurance Brokers, have been doing that for the past 17 years, and have been doing private to public transitions in Silicon Valley and the Bay Area since 2001, so almost 25 years. I'm very passionate about this topic, I'm very passionate about working with boards, and we have some fantastic guests joining us in the conversation today, talking about some of the underlying issues that back why we think about what we're doing from the brokerage side. So we'll let each of those individuals introduce themselves, starting with Patrick and then Christine.
Hi, everybody. I'm Patrick Gibbs. I'm a partner at Cooley in Palo Alto and currently serving as the head of the firm's securities litigation and enforcement group. My practice runs the gamut from traditional stock drop securities litigation to M&A and other kinds of corporate governance, fiduciary duty litigation to SEC enforcement matters. But I also spend a lot of time counseling our corporate clients and directors, both pre and post IPO, around corporate governance and also especially sort of public company related issues.
Hi, good afternoon. My name is Christine Gorjan. I am the former CFO at Netgear and Arlo Technologies. I currently now sit on the boards of Juniper Networks, Invitae, which is a genetic health company in San Francisco, Carbon Health, which is a private company, and then Shapeways, which is a public 3D printing company.
Fantastic. Thank you both for the intros. I should mention before we get going here, there's a chat on the side. So if you have questions throughout the presentation or would like any of our panelists to comment on a particular topic, please feel free to chat and we'll do our best to get to your inquiries. To get us started, I thought it'd be good just to get the lay of the land. In the past year, there's been quite a bit of volatility, at least in the directors and officers insurance market in the past 3 years. And the underlying risk behind that really lives in Patrick's world and Christine's world. So I kind of wanted to get some commentary from Patrick on how he views the securities landscape and maybe with Christine from there.
Sure. Thanks, Joseph. So I think I would put the current landscape, I'd think differently about two different buckets of cases. There's the class action litigation under the federal securities laws, so 10b-5 cases, or in the case of an IPO or another registered offering, you've got the strict liability cases. So the securities class action litigation under the federal securities laws is one bucket. And then the other bucket I would say is developments in fiduciary duty litigation in Delaware, generally in the context of shareholder derivative suits. And on the first bucket, I think that there's a little bit of good news, bad news. I'll start with the bad news. The bad news is that the plaintiffs' bar continues to get more and more aggressive over time. And in my perception, the courts have slipped a little bit in terms of really rigorously enforcing the Private Securities Litigation Reform Act. And so we see a decent number of cases that are getting past that pleadings gate and into discovery. And that's causing it to be, it takes longer and increasingly costs more to get those cases resolved. So that's the bad news. The good news is because of significant changes in the D&O market, companies that are going out right now or that are in the market right now for D&O insurance, I think have a lot more options available to them and are able to have some very thoughtful discussions about how to shape their programs in a way that best suits their needs. So that's the good news on that side of it. On fiduciary duty issues, to me, the most interesting and important trend has to do with duty of oversight cases. You guys may have heard lawyers talking about caremark duties. That's basically director or fiduciary duties to oversee the company and basically to manage risk. You have oversight issues whenever the company ends up violating the law or getting in trouble in some way, and the shareholders claim that the board did not properly oversee the company, did not properly manage risk. For a long time, those cases were routinely, almost uniformly dismissed because you had to allege very specific facts showing that the board was aware of red flags but ignored them in order to have a viable claim under that theory. In recent years, there have been a handful of cases in Delaware that have allowed these duty of oversight claims to proceed, not based on facts showing that the board was aware of specific red flags, but in fact, based on a showing that there were really bad facts that the board didn't know about. And the theory is the board breached its duty because it did not have adequate monitoring and information reporting systems in place to make sure that the board was apprised of kind of enterprise threatening important risk areas. And so to me, that's a much scarier prospect, to be held liable for something you didn't know as opposed to being held liable for something you did know. And so I think that's causing directors to have to spend real time and energy focusing on identifying risks and then making sure that you're getting the information you need from management in order to assess whether the company's properly managing risk and to exercise that duty of oversight. So that to me is a pretty significant change over the last 3 or 4 years. I think those to me are the trends that I'm seeing. Most specifically, I guess the last thing I would say, this is not going to be news to you, but with the change of administration, the SEC has certainly taken on an extremely aggressive posture compared to prior years. So they've been very, very, very active. And in particular, they've been focusing on not just the traditional fraud-based claims that you think about the SEC pursuing, but they've been digging into issues of whether the company has adequate controls over financial reporting, adequate disclosure related controls, and the like, which is a little bit more nuts and bolts than we're used to them getting into. So those are the trends that I'm seeing.
Great, thank you, Patrick. So I guess on the backdrop of all of that, Christine, really interested in hearing your perspective as a director on how you sort of think about these risks in today's environment.
Yeah, I mean, my short answer would be the risks continue to multiply. I can think back to 5 or 10 years ago, and we in California worried about an earthquake. And, you know, then cyber incidents, but now it's geopolitical, it's regulatory, it's supply chain, it's chips, it's talent. So I think that universe just continually gets bigger. So, you know, and as a board member, we have to oversee risk and as it applies to the strategic direction of the company. And so I think the key is making sure that the company has a robust enterprise risk management program, that it's documented, that it's sits in one of the committees and it's reported to the board probably twice a year. And then, you know, looking at what are the mitigation that's put to the risks. So that's something we might review more on a committee. Does the company have a good incident response plan? And when the board gets notified, and then it's a continuous monitoring and adding risks and maybe reshuffling the order of the risks. And I would say it also depends on the size of the company, or how sophisticated they are, how long they've been public, how good these programs are, and how much rigor has been applied to them. So I do think it's something they need to start doing quickly and try to build that. But I will say, just looking around and on different size companies, they're at different levels, but it's just really important for the board to oversee it. And sometimes the information comes very nicely, and then sometimes the board really has to get down and ask for it, help them with what we want to see.
Yeah, that's really helpful and insightful. Thank you, Christine. I do want to talk about directors and officers insurance, because I think it's an important consideration in addressing a lot of these matters. And you know, there's in our side on the brokerage house, we've seen quite a volatile market in terms of what the insurance companies have been doing over the past, I would say, 5 years. It's sort of increased dramatically in cost as a result of what was happening with their balance sheets. And I would say probably, you know, of the top 15 carriers that underwrite this risk, it used to be that, you know, 70% of them were making money, and then, you know, that dropped down to maybe 10% of them actually being profitable in this line. That's changed, and we're seeing that. We're seeing that in the market in the past 18 months, I would say. There's been a pretty dramatic decrease in pricing on D&O, as much as 50% in 2022. And then into 2023, we saw further decreases. It's been pretty dramatic. It was almost, you know, month by month where we were seeing changes in the market. And so, you know, one of the things that we've experienced is just different perspectives in how boards and executives were purchasing this line of coverage, all at the same time, of all of these various factors that you're talking about, Christine, rising in terms of the complexity of risks that are needing to be addressed. And in addition to the pricing changes, insurance carriers were increasing retentions pretty substantially in new public offerings. It used to be you could get $1 million self-insured retention pretty easily, and there was a period of time where we couldn't get anything for less than 15 million self-insured retention. So that's changed lately. We're back down to million. I've actually seen a couple under $1 million lately for smaller deals. But $1 million to 5 million is where the market is right now. I expect that all of these trends will continue. But considering that we've had what we've had happen in the D&O market, cause what I would say just changes in how you buy insurance. I'm very interested to hear both from your perspective, Patrick, how you think about D&O and working with your clients and how they consider D&O. And then also, Christine, from your standpoint as an insured, how you think about that, because it has been a pretty dramatic ride in the past, 2 to 3 years in particular.
Yeah, I would say it has been a pretty significant change, as you said, and it has changed the behavior. In the period where you couldn't get a self-insured retention of less than $10 million, and some of them were even higher. You also had relatively high prices for the coverage to begin with. We had a lot of clients who went out with very high retention amounts and relatively modest coverage for obvious reasons. But and much of the time that works out just fine. But with a $10 million self-insured retention, that just means that in the vast, vast majority of cases, the company is paying to defend the case. Barring a really, really unusual or unusually large case, that means the company's going to pay to defend, and the insurance is really only there for settlement, which is a very different situation to be in, and can put pressure on companies in terms of timing and amounts of settlement. So it's a really good thing from my perspective, certainly, to have the retention amounts come back down, to give people the means to bring the insurance to bear to defend the case, and allows them to hang in a little longer if need be, and strike a harder and better bargain when it comes to settlement. And I do think, frankly, there were companies that went a little bit skinny on the coverage, and that combined with the increased cost of defending these cases going a little deeper into discovery, has definitely put some pressure on our ability to get cases settled within insurance amounts. So I also think it's good for directors, it's good for companies that the pricing is coming down, because I think it's worth having a little bit more when you can afford it. So that's those are the main changes. It's just a more insured friendly environment. And so I'm hoping the companies will take advantage of that. One interesting development that I've seen recently, and this is very recent and very different from prior experience. Most of you probably understand that there's two different kinds of D&O insurance. You have your traditional side A, B, C coverage, and then you have your side A only coverage. And without getting into too much detail here, the traditional ABC coverage protects the company's balance sheet. It basically reimburses the company for amounts that the company pays to defend and indemnify. The side A only kicks in when the company is not indemnifying. So in practical terms, that means if the company goes bankrupt, and it comes in to protect the directors. And historically, you'd see most programs be made up predominantly of that traditional ABC coverage, and then you'd have a fraction of that in side A coverage only on top of it. That's a pretty typical program. I've recently seen a number of clients going out with programs with a lot less ABC coverage and a lot more side A only coverage. And one of the things I think that reflects is a lot of the companies that are going out these days are much larger. They're staying private much longer. And so by the time they go public, they have really, really robust balance sheets. They're a little less worried about balance sheet protection, and they're more focused on shifting resources into the side A piece of things to protect against the sort of major corporate meltdown disaster as opposed to protecting against the more routine stock drop cases, which we'll see how that plays out for people. It's a decision, it's a judgment, and it makes some sense. It has some logic, but probably going to be some people wishing they bought a little bit more ABC is my guess, but we'll see.
No, that's actually a good observation, and we've definitely seen that on the brokerage side too. In fact, I had a panel last year talking about a company setting up a captive insurance program to completely fund their D&O risk. So that was a really regular conversation that we were having last year, was how to self-insure more on the D&O side. Interested to hear perspective as a director, Christine, in terms of how you think about that and evaluate that as somebody who's insured by the product.
Sure. Well, I would say D&O insurance, it's a necessity if you're going to add people to the board and for the executive officers and the board. So everyone's interested in protecting, themselves personally, and that. What I would say is there's been more discussion in the board than there probably was a few years before that. I would say we always come in and looking at the limits and kind of looking at the peer groups and say, do we think we're adequately covered? What's going on and all of that? And I would say, the brokers can do a really good job of coming in and explaining that. And most often they come in annually at that meeting where it's close to the renewal date and walk through the deck that shows a little bit of what our prior coverage was, what some of the options we have. And those options might be more of the ABC or add another 5 or 10 million on the side A. And then kind of looking at the peer groups and then look at the settlements. Because I think the one thing that's been interesting that I think I can remember correctly is the settlements are going up. And so kind of looking at, do we think we're covered, and is it too much? Is it not enough? And that's where the brokers, I think, come in and really try to help and give some good advice. And then I think the board has felt comfortable when in the process they've gone out, the brokers have gone out and marketed the policy. It necessarily, we don't want to change who's, holding the primary coverage in that, but it's nice to know that we've gone out and marketed it to see this is the best deal, we can get, or this one makes the most sense. And so it's nice to see that. So I think we talk about it more than it probably was 5 years ago, as far as, yes, everyone wants to make sure they're covered. Do we fall in the peer group in that? But there's more questions on it. So it's nice to get the broker into the board meeting. And that might be 10 minutes and it might be more, because then people tend to ask other questions like, what about cyber insurance? And what about this? So that's where I've seen it over the last couple of years.
Awesome. Thank you, Christine. So I want to talk about ESG just for a little bit. The D&O insurance market is paying attention to ESG. They have changed their policy forms to grant coverage enhancements in and around ESG matters. There's certain carriers that are, giving additional language specifically calling out ESG crisis events and looking to support their clients in and around these matters. I know it's a really big topic. I know that, the hot sort of topic right now is in and around climate. DEI was the big thing, a year ago. I don't want to discount any of these matters, but in any way as sort of a trend. But I do think it is important to talk about what's happening there, practically speaking, both from your perspective, Patrick, and also from your perspective, Christine, and sort of maybe share for the audience how they might want to think about some of these matters from a practical director liability perspective.
Yeah, it's a good question. It is definitely a thing. I can recall not that long ago, I was on a call in connection with an M&A deal, and somebody brought up concerns around ESG disclosures and SEC enforcement. And I have to admit, I was I was a little dismissive of the idea because so many of these ESG disclosures are sort of amorphous and aspirational and not very concrete. And so I was thinking, that's just, there's no real meat there to the disclosure issues. But within weeks, I saw the SEC going after some people for very similar ESG related disclosures. So it was kind of an eye-opening moment for me. So from my perspective, one of the most important features of ESG related issues here is precisely what I said, which is a lot of the ESG language that companies want to use is very broad. It's aspirational. It's not very precise, not very concrete. But instead of meaning that just means you can't really get tagged for a disclosure violation, it's kind of the opposite, right? The very breadth and vagueness of some of these statements are creating opportunities for the SEC and for plaintiffs' lawyers to come in and say, there's any number of things that render these statements false or misleading because they're being read as, sort of these broad guarantees about your company's behavior and its interactions with the world. And so, from a director liability standpoint, I would be advising people to try to make sure that whatever the company's saying about ESG efforts is as specific and as concrete as possible so that you can sort of establish that it's true, and try to avoid the more sort of grand, wide-ranging, non-specific and aspirational statements, because those kinds of statements are just very, very high risk.
Yeah, we have a really good message or a good chat that just came in about Disney and the state of Florida and how that impacts director liability. And I think I would take that in and make it, a little bit broader in terms of how you think about the backlash and ESG in the market, because there was this really, sort of pro-environmental, pro-ESG movement, and then there was this backlash that happened in the market. And so if you're a director, you're sort of sitting there going, okay, well, I'm damned if I do, I'm damned if I don't. It's how does a director navigate that on both sides of the fence, because it is a real issue.
Yeah, I agree, and I think it's one manifestation of the fact that the things we think about in the ESG space, they end up getting you into kind of disputed political territory, and for a period of time, there was kind of one side of the political spectrum was very adept at using these mechanisms for advocacy purposes, really, and now we're increasingly seeing both sides of the political spectrum, buying 2 shares and then lobbing in demands on the directors and lobbing in shareholder proposals for the proxy and that sort of thing. And so companies like, and Disney's a great example, they're getting pulled into and being used as, sort of tools in the culture wars. And there's no easy answer, because the fact of the matter is most of the companies who are out there pushing ESG and DEI and some of these other issues, they're not doing it for nothing. They're responding to real impulses and real desires and needs for their employees, for their customers, for some of their investors. And so that it's not like they can just say, we're just not going to get into political stuff, because there's a real demand for it among the constituencies that they need to be responsive to. There's no great answer, because it just is the case that doing that now poses the risk of getting clobbered by the other side, to some extent. I think it just means heightened awareness and trying to be very, very clear and transparent and specific when you're speaking about these issues. I will note in the Disney case, in that situation, that is, there was an interesting Delaware decision where a shareholder on the right side of the political spectrum made a books and records demand on the Disney board based on the spat with Florida. And in a fairly unusual decision, the Delaware Court of Chancery said they had not shown a proper purpose for the demand. And I'm saying that's fairly unusual because proper purpose for books and records demand is a very, very, very low bar in Delaware. It's very difficult to defeat one of these things if you get it. But in the case of the Disney matter, the court said that it was a matter of business judgment, and it was so clearly a matter of business judgment for the board to decide to take the position that the company took, that there wasn't even a basis for the shareholder to demand books and records, which again is normally a very, very, very low bar. So that's good news from a director standpoint, because it certainly suggests that there is room for business judgment around these issues, room to decide how are we going to respond to the various constituencies who want the company to take a stand on various issues. But it doesn't mean the risk is gone entirely. It's one good piece of news, but it's still a fairly fraught area.
Yeah, and I can comment a little bit from the underwriting perspective, but I actually first want to hear from Christine on this topic, because I think you probably have a lot to share about this, and it looks like we also have some questions about the more significant risk in the EU in and around these climate issues, and I know that California has their initiatives as well. So very interested in hearing your thoughts on this, Christine.
Sure. Back to the sort of the climate disclosures and all that, I would say the companies have been making a lot of disclosures. There's typically a sustainability report that's somewhere if you go to their website, and there might be some other just naturally going to other places on the website. So I think the first thing the boards or say in this case the audit committee is trying to do is to get it all in one place, and to bring in internal audit or something to audit the sustainability report, because there initially were a lot of numbers in there that may not be calculated the same way from year to year as the accountants would do, or something to have some consistency and some historical numbers. So I think looking at trying to get that document and internal audit, bring them in, let's look at those numbers that we're disclosing, because they're not in the SEC reporting documents for the most part so far for a lot of us. But when they go in there, we have to have really good, robust procedures. We have to have controls over them. So I think a lot of that work has started. And so I would agree, keeping it, I wouldn't say simple, but keeping it to fewer disclosures or meaningful disclosures. And so we're working through that, to be honest. It's ESG is divided up between different committees. How do the committees coordinate? Do the chairs meet? Do they have overlapping committees? There's all of those things being addressed, because the social part of it often ends up on the comp committee. If it's going to end up in an SEC document, it'll be on the audit. But then also NomGov kind of tries to run and disperse the whole thing. So I think it's companies are trying to do the right thing. I think that, again, the bigger they are, they've hired people, they're working on it, and it's something the employees are really, really interested in. So I do think this then kind of bridges over to even say the Disney topic. I think the CEO, he has a hard job in today's world to balance the shareholders, the employees, the customers, the vendors, and to as going out and talking about all these things, whether it be the DEI or emissions and that. What is it we want to say? What's the message? That they be consistent and that they be thoughtful and listen to all of the constituents on that. The other thing I'd say, probably want to have a good crisis consultant on speed dial these days, just in case you actually, something blows up that maybe you didn't necessarily expect to. So I do think we talk about these issues, but it's hard to tell, when some of them are going to come up, and then some of them you might know as it's coming and you could prepare beforehand.
That's really helpful. Thank you, Christine. I would second your sentiment on a practical approach to these things, because I can tell you from an insurance perspective, insurance underwriters like people being practical and thoughtful. And if they ask about ESG, the expectation is that you've thought about it and you've had a practical approach to it. And, it's not just something that you're throwing out there. It's something that your group has thought about and can answer clearly why you're doing what you're doing. So I think in terms of D&O risk and how the underwriters will perceive the board and what the company is doing on that matter, you're right on with your commentary about being practical and thoughtful about it. And there was a question that just came in that, let's see here. Do governance practices truly impact D&O rates charged to a particular company? Do you want to answer that, Christine? I have my answer on that, but yeah.
I would say yes. I mean, I think one of the interesting things about marketing that program, and I did this more when I was a CFO than on the board, we would go meet with the insurers every year, and we would go through not only our investor presentation, but we added a whole governance section on it. Who's on the board? What are the board policies? All, we did a lot of work on that, and the general counsel was always right there beside me doing that. And I think that made a difference of trying to be somewhat transparent with the insurance companies, who we are as a company and what we believe in, and where, ethical standards, codes of conduct, and that. I think it helped us, and I'm not sure how much it helped on rates in that, but it definitely got more insurers interested, and they did seem to like that.
We're getting a lot of questions in here, which is great. And I will second Christine's commentary that it does matter in terms of how it matters and how a D&O underwriter will price your deal. I guess to some extent the market rules, and so from that perspective, that question is actually right, that your governance, it didn't matter if you had the best governance of all the companies in the market 2 years ago. You were going to pay what the market bared at that time. And so from that perspective, it doesn't matter. The market matters more. However, I will tell you that the range of what you can get in the market is pretty substantial. And when I talk about the range of what you can get, what I mean is, whether your retention is $1 million versus 5 million or 10 million, whether your, premiums are, 25,000 per million versus 200,000 per million, that range is pretty dramatic. And to the degree that you can soft sell, if you will, with information about how well run the company is and your governance practices, and really spending the time to communicate that, it does impact where you end up on the scale of terms, conditions. There's certain underwriters who just, will not offer you certain terms if they don't feel comfortable with your governance. And so, and in the world of D&O, and Patrick can probably speak to this, tiny nuanced language in the policy can make a really big impact in terms of what the insurance carrier does in the event of a claim. And it doesn't seem like a big deal in terms of the amount of language that's on there, but a small word here and there can make a big impact. And they only do those things if they really feel good about how well run your company is. There's another question about how much coverage a private company should carry for D&O. I have a actually different, Christine, I'd be interested to see if you have a perspective on that. I have benchmarking that we do internally at our firm that depends on whether or not a company has alternative investment, whether it's venture or private equity money. And our thought process behind that was that nobody was really monitoring that historically, because they just felt like every company that had $10 million in revenues should carry the same should carry the same coverage, because they were benchmarked at $10 million in revenue, and all $10 million in revenue companies should carry the same coverage. And so we said, no, we don't necessarily agree with that. A company with $10 million in revenue and has $150 million, $200 million in funding is a very different risk profile than a company that, raised $1 million to get their seed funding and they're just kind of coasting at $10 million. So two companies, $10 million in revenue, totally different risk profiles. And we felt like we should monitor that. So I would say that, if you have a professional that you're working with that is thinking about those things in that context and really understanding the dynamics of what drives management liability risk, they'll be able to share with you some data points that might inform how you might want to think about that risk. And particularly if you're sitting on a company that's pre-IPO, that's a really big deal, or a company that's engaging. I had a client, acquire, 70 companies within a 2-year period. I mean, that just screams D&O risk to me. And so there's another question. I'm sorry, Christine, did you have more comments on that?
No, I'm fine. Thank you. Sorry.
There's another question in here. It says, is one's umbrella coverage or a special D&O policy that provides extra coverage and is like a reinsurance that would provide secondary coverage, which gets cost for legal costs first? I'm not quite sure I understand that question, but I will tell you that in addition to the D&O coverage that you as a director have for any company that you're sitting on a board for, whether that's a public company or a private company or a nonprofit for that matter, there are programs that can supplement what that particular board is carrying if you feel like that company is not carrying what you want it to carry, whether it's a coverage terms and conditions. Hopefully your attorney or your broker, your personal D&O review is looking at these things for you and giving you commentary. Hey, you're sitting on a board of a healthcare company and they don't have the appropriate D&O coverage for what a healthcare company should have, because that's a really specific thing. You can address that through, fill in products personally and address it if the company is unwilling to. And most venture funds and private equity funds have something called private equity liability or venture capital asset protection or general partnership liability. And all of those programs give additional D&O coverage for board seats that you're holding. So there is, if you're involved or participating in a board seat in that capacity, there may be additional D&O coverage above and beyond whatever is at the portfolio company level or at the board level for the various directorships that you're taking on. So there's options out there. And I would just ask the professionals that you're working with, what else you can have, because there's a lot of different ways to address it if the company's unwilling or unable to get the coverage that you want.
I would just add that though, at least in my experience, outside of the context of a director who's sitting there by designation of a private equity fund or a venture capital fund, outside of that context, I don't think I've ever encountered a director who had gone out and purchased separate insurance individually. And I haven't had directors who've been required to write checks by virtue of not having that insurance. So that's not to say it would never be appropriate. It's definitely not the norm, at least from what I've seen.
Yeah, I would comment on that in the past 2 years, we had a lot more inquiries about it because we actually had companies underfunding the D&O risk because of the cost to buy it. So we got a lot of inbound inquiries about what additional protection they can have, much more so than we've seen historically. And so there were products that we hadn't written in, a decade that were reopened up and re-explored. And, they're not as common now that the D&O market is fluctuating back down in terms of the cost, and companies are more willing to buy higher limits. So I think that's a relatively nuanced trend that we saw in the past 2 years, where we were regularly exploring these, somebody might have 5 board seats and they just didn't feel comfortable with what was being carried across all 5 boards. But yeah, it looks like there's a comment in here that if they don't want to carry the coverage, then you shouldn't want to be on that board. I had this discussion last night with a board member, actually.
Yeah, I have a lot of sympathy for that point of view. I get it. I feel the same way. I think it's something the company should do, to be perfectly honest. I think that's just part of the deal.
Yeah. We have about 15 minutes left before the panel's over. We haven't talked about AI or cyber or how board members might be thinking about that risk. Before we jump into that, whole can of worms, is there anything that we haven't talked about that either of you were hoping to share with the group today, and then we can get to that topic, because I think it's very relevant and continuing to get more complex.
No,
for me.
Awesome. So there's been a lot of scrutiny around cyber risk and attending to it and monitoring it and reporting on it. There's been a huge interest in artificial intelligence and where that lives in the company and how that creates risk for companies. Very interested in both of your perspectives on both of these topics. If you want to tackle them in conjunction with each other or separately, however you want to do it. We'll start off with you, Patrick.
Well, they're certainly they're very hot topics for sure. I mean, although cyber, I would say now has been a hot topic for a long enough time that I feel like people have a pretty good handle on it. It is unquestionably a very important area of risk, but at least in my experience, companies have kind of caught up with that. As a director, though, if you're not getting very, very robust and satisfactory answers around cyber risk issues, you need to press hard to get them, because it's really not a good idea to be ignoring it, because it's a huge risk issue. AI is newer, obviously, and AI is an interesting one and a very tricky one, because it has kind of two sides to it, right? From my perspective, one area of risk that's already showing up in SEC activity is companies talking about what they're doing in AI. And, everybody wants to say they have an AI story. And I think that's creating pressure on executives to present an answer, a story, a plan, or whatever. And sometimes those things are pretty aspirational. So that's an area of risk, is just sort of feeling pressure to feed the market information that may or may not be fully baked. And then on the other side of it, obviously, is just the risk disclosures and understanding to what extent does AI pose a risk to your business. To what extent is your business at risk because people can just go get the information they need through some kind of machine learning tool or AI tool. That one's tricky, I think, because I'm not sure people necessarily know, right? And so that's an area that's just infused with the risk of hindsight bias, right? The risk is going to look really obvious after it's happened. I don't know that it's going to be obvious to people in real time.
Yeah, I agree on the cyber. We've had it. It's been around for a long time. It keeps evolving, and it's obviously never going away. And I do think that the key there is the boards are getting regular presentations, if not quarterly. Companies are hiring a CISO, and it's still not necessarily, if you get attacked. It's kind of when, and can you find out really quickly and stop it. And I think the new SEC regulations are, I've already seen a couple of instances of just the last 2 weeks, people filing 8Ks. And I think we'll be seeing probably a lot more of those on that. But I do think, even like insuring it, can we insure against it? Then I think sometimes insurance doesn't pay ransom, doesn't, do this. So I think the coverage is getting more expensive and ruling out different things it'll pay for. So I think the answer really is the company just has to focus on it, have a robust program, and continue to build that as the bad guys continue to build out in front of that. And I think that's something we're all aware of. Again, I think the key on that is that incident response plan, especially now with this, 4 days after it's material, you have to be reporting it. So what is, kind of re-reviewing that response plan, and when does the board get notified? A couple of my boards have a CIO or a CTO person on there, and that is the first contact. And the comment there that she would make is, I'd rather you call me and I tell you I'm not interested than you not call, or it's fine, you're doing great, give me the call. So I think that's really the key, is people have to go in now and look, is how are we going to get this reported within 4 days, and what is material to us? How are we going to determine that? So I think there's some work has to be done on that we didn't necessarily do as far as getting it reported publicly quickly. And on AI, those discussions are happening everywhere. I heard on the conference calls for the last quarter, I mean, AI was mentioned an exorbitant number of times by just about every single company reporting. And the first part is like, what is the data governance so you don't send your IP out the door by, putting it in Chat GPT or something like that. So a lot of companies are coming up with kind of what is that just governance model with the data. And then they know they can't outright ban it. Some are doing that because people are going to use it anyway. So I think the key now is to educate people on how to use it or how not to use it. And then, kind of working through that. I think I was talking to someone at Google. She said they've got their AI data governance, just it's out on the website. And it's, she said it's something good, take a look at it. But get that governance in place. And then that's going to be something I think we're consistently constantly looking at as we go forward and learning where we're using it in the business, whether it's in the products or whether it's for customer service or whether it's just to do our daily jobs faster in that. I think there's a whole lot of things we don't know about that yet.
I would just add from the director liability standpoint is a question about, if an employee does something that causes the loss of IP, this gets back to the oversight issue, right? So, and the answer is usually a process-oriented answer to some extent, meaning if IP is important, and it is for almost everybody, directors need to be asking management, what are you doing to make sure that we're not putting our IP at risk? And if AI or open platforms are a particular risk, then what I would say is you need to ask the question, you need to get the information necessary for you to get comfortable that they're managing that risk. No risk management program is perfect. They can't guarantee that it will never happen, but you can assure yourself that there are processes and people and policies in place that are designed to mitigate that risk. That's what you can do, and that's what you're ultimately going to want to be able to point to later if the disaster happens. You want to be able to say, we asked the question, we got the information, we exercised our judgment about what was an appropriate sort of set of protocols to have in place. And the fact that they weren't perfect doesn't mean the director should be held liable. That's what you want to be able to say. What you don't want to say is, I knew it was a risk out there, but we just didn't talk about it at the board level. We didn't get a report from management. We didn't ask the question.
Awesome. Thank you, Patrick. There was a question that came up earlier. We're cutting it close on time, and I want each of you to sort of leave some final thoughts. But before we do that, I want to answer the question about working models in and around self-insurance for companies. And if we could maybe suggest on some working models, and I'm more than happy if Patrick and Christine, you want to comment on this, I'll share briefly what my perspective is on it. There's formal insurance structures, like captive insurance companies where the insured owns the insurance company. And you can organize a captive insurance company that's owned by your company if you have a strong balance sheet and you have the internal risk controls in place to really do that. That's one way to address it. The other way is to not utilize the formalized mechanism of captive self-insurance, and you can just take the risk. So what that looks like in the world of D&O is a self-insured retention, which most companies have, but you don't have to take it in a self-insured retention. You can build in self-insured risk in the form of something called co-insurance. It's almost like a sharing of a layer where maybe you want $20 million of coverage, but you're willing to self-insure for 10% of that. So all the way up through the tower. When we look at D&O programs, most of them are layered in, 10, 20, $25 million chunks of coverage. But within those layers, you can also share risk with multiple insurance companies. You can share risk with the company itself. So there are different ways to mitigate cost on insurance. And I always tell our clients, the most inefficient way to address risk is to have an insurance company insure for it. There are reasons you do that because it's much more beneficial to have somebody else pay for a claim than your balance sheet. But if you're not asking about cost mitigation strategies and different ways of thinking about self-insurance risk in and around D&O, I would definitely ask whoever you're working with to give you some thoughts on how you might want to restructure that and potentially self-insure if you feel like the company is able to. Not every company is able to do that. I don't know, Christine or Patrick, if you have additional comments on the self-insurance side.
I don't.
Yeah. Great. Well, I will, we've got 5 minutes left. I want to spend that time to leave Christine and Patrick with some final comments for the attendees today. If there was one thing you wanted to leave the attendees with in and around what they should think about for director liability, what would that one thing be?
For me, I would say I think directors need to, it's sort of in a bucket, educate yourself, educate the board, stay current, one, so you can ask good questions. And the other piece of that is assessing management skills. Are they doing a good job of the risk management program in the cyber, in the AI, legal and compliance department? Are they up to speed? Because we are depending on the management team to bring us a lot of that information, and to their skills will probably dictate some of the level of questions from the board. And then I can't stress enough, having a good incident response plan. You can use it for all sorts of disasters and incidents, and because the time is of the essence when that happens, and getting information to the board also. So I just wrap that up that way.
Yeah, I would echo that, and I would just say ask questions, ask more questions, ask more questions. You can't do all the work, you can't know all the facts yourself, but you can ask enough questions to get yourself comfortable that management is doing what you expect management to do, and that they're giving you the information that you need to get. So just asking the questions to make sure you understand what's happening inside the organization as best you can from your vantage point is going to be the best way to protect yourself against risk.
Awesome. And I guess I'll leave my final comments in support what both Christine and Patrick are saying in terms of asking questions and have a good incident response plan. But I saw a lot of this in on my side in working with our clients in 2020 and shortly thereafter, of just being aware of all of the various global and social dynamics that are happening in the world is really, really important. We had really qualified people that were unaware of certain things that were happening in the world, and it was causing a lot of stress just because they weren't informed on certain topics or certain ideas or things that were happening in the world. And I would say that having an awareness of those things and reading a lot, asking questions about what's going on globally is super helpful to sort of layer on top of the infrastructure that Christine and Patrick are talking about in terms of incident response plan. So, Lisa, I'm going to stop there and hand it back to you to close out for the NACD's session today.
Thank you so much, Joe. And thank you too to Patrick and Christine. It's been such an informative hour, and we could go on, but I think you've given us so much food for thought, and appreciate all of our attendees as well. Look forward to seeing you at a program very soon. Thank you.
Right. Thank you.
Thanks, everybody.
Thank you, guys.
And then there was us.